Good evening, everyone, and thank you for joining us this evening. This event is covering the road to IPO and beyond, private and public tech companies in DACH. My name is Orla Brown. I'm head of content at dealroom.co. Dealroom is Europe's foremost data provider on startup and growth company ecosystems in Europe. And we're really pleased to be partnering with Deutsche Börse Venture Network today for this event. So I'm joined here by Dealroom founder and CEO Yoram Wijngaarde and Peter Fricke, head of Deutsche Börse Venture Network. You'll mostly be hearing from them this evening. But as you might have seen, the event today is brought in partnership with a report on the same topic that Dealroom and Deutsche Börse Venture Network have jointly published this morning. Hopefully you've had a chance to have a look at some of the findings, but if not, don't worry, we're going to be running through some of them this evening. We've got even more insights in the full report though, so I would encourage you to go and download the report later and have a read of everything that's in there. It includes some extra case studies and interviews and also extra data as well. So yeah, without further ado, we're going to kick off with a run through some of the findings. We'll then have a bit of a chat about some of the main topics in there, but we'd also like some of your input as well. So if you have any questions for Yoram or Peter, then you can put them in the chat and we'll try and get to as many of them as possible. So yeah, I think we're going to start with Yoram, who will kick us off with the data.
Yeah, great. Thanks, Orla. I will start with the road to IPO and beyond. And for this session, we've streamlined the report a bit that we shared this morning, so it will look a little bit different to accommodate the conversation. And we split the presentation up in 3 sections, starting the first section about the DACH tech ecosystem, where it's come from and where it is now. And I think most of you probably know that tech stocks are pretty hot at the moment worldwide. But if you add all that up together, what does it look like? So what we call the DACH tech ecosystem, which is comprised of, in this case, companies that have been founded since 2000. And we take the year 2000 as a kind of cutoff year because that's when most of today's big tech companies that have been kind of created in the information age, using internet, building software that's distributed over the internet, have been built. And if you add those companies up together, then you look at companies like Delivery Hero, Zalando, but also Bio and Tech, CureVac, HelloFresh. So these companies that have gone public since have now reached a valuation of 89 billion. And there's a group of other public companies as well. So if you add those up as well, you're at 124 billion. But then there's also a group of private tech companies worth around 150 billion. And we've listed the top 5 of them, including Auto1 and N26 and Viam. And those valuations are not public, so they're based on disclosed valuations of the last funding round, for example. And in cases where it was not disclosed, we made an estimation. But I believe for all the biggest private companies nowadays, they're quite open actually about their valuation, often because they're actually already preparing to IPO. So this adds up to 264 billion. And just 5 years ago, this was only 62 billion. And what's also interesting here, I think, is that the increase of the dark blue part goes from 17 to 124 billion. So it's a 7.5 times increase in just 5 years. So it's really incredible. So what part of what's been driving that is VC investment and European-wide VC investment. This includes the UK, of course. You can see it has reached 38 billion in 2020, almost equal to 38. And I think we should look at that in the context also of the pandemic. So the impact of the pandemic has been that there was a slight decrease of venture capital investment around March, April, and May. So some uncertainty. Some investors didn't really pull back, but wanted to kind of wait and see what was going to happen. But soon the excitement came back in, and actually Q3 and Q4 of this year were one of the most active ever. And January of this year is perhaps the most active. We're just shy of already being the most active year or month, sorry, ever. And on the right, you can see some of the deals that are in here. So the bottom part in dark blue is for the DACH region. And you see that this goes down a little bit between 2019 and 2020. So what's going on there? So this is on the next page. And actually, if you exclude the mega round, what we call mega rounds plus, so rounds over 250 million, then still 2020 is an increase versus 2019. Now, why would we exclude those rounds? Just to give a sense, because in 2019 there were a handful of very unusually large rounds for Flixbus, GetYourGuide, Frontier Car Group. Those three alone were 1.5 billion in investment. And if you talk with VCs and founders and startup teams in the DACH region, the sense really is that 2020 was probably the most active year ever. And I think that this, looking at the data this way, better reflects that. So there were a lot of big deals still happening in 2020, as you can see here with Auto One, Tier, Lilium, and so forth. And also January was exceptionally busy for the DACH region, with rounds for Personio and many others. So putting that in context, on a European level, you see Berlin is the #2 ecosystem in Europe, next to Paris. But then Paris, Zurich, Hamburg are really up there, so you have basically 4 of the DACH cities in the top 10. So despite all that money, despite all the money that's being raised by the VC funds, and you can see that here. So this is basically a European perspective. The money that VC funds are raising is also not enough, and they cannot really keep up with the demand that comes from startups. So startups have to look beyond Europe to raise capital for growth capital, and that has always been the case, but it's even more the case now. And you can see that in basically the gap between the bottom gray part and the total chart. And so that gap is being funded by investors like SoftBank, Amazon, Sequoia, Tencent, Insight, and so forth. So these are kind of either American funds that are very active in Europe, and that's increasingly the case. So more and more American VCs are investing in Europe, but there are also Asian investors and private equity groups, and Temasek, for example, is a sovereign wealth fund. And so late stage capital is still a challenge in the DACH region and in Europe. And therefore unicorns, what you see they're highly dependent on international investors. So what this chart shows is the dark blue part shows how much of the capital is raised domestically. So 67% of seed capital is raised domestically, and this shows investment for DACH companies between 2000 and 2020. And it says here DACH unicorn, but I think that must be a typo. It's probably DACH startups, I think. But so what this shows here is that for Series A rounds, between 4 and 15 million, 47% is raised domestically, 33% for Series B, and so forth. So when you go to Series C and mega rounds between 100 and 250, almost no capital is raised domestically. A bit comes from cross-border European, which mostly means it comes from the UK actually. And a lot of that UK VC money, so Index Ventures, Accel, Atomico, they also raise from American LPs. So this is actually a lot of money also coming from the US and Asia. Here for Mega Rounds Plus, it goes up again a little bit, but you have to take into account this is a much smaller sample because there's only a handful of rounds. So you can see again, this has to do with Flixbus and 26, but it does have a bit more domestic capital. And I think that the prospects are getting a bit better because you see now some larger funds starting to arise, like Lakestar and others. So now kind of looking ahead to the pipeline of promising exit potential unicorns that are coming up, but also looking at SMEs. So because of the rise of these unicorns, a positive kind of flywheel effect starting to occur. There have been some important early exits, so it's what you see here, like Zooplus, Hybris, that was sold to SAP, but also, for example, if you still remember CityDeal, that was sold to Groupon, which was really an important exit for the ecosystem. Mytheresa in Munich, Westwing, Unify, and then of course companies that went public here. So Delivery Hero, Zalando, and HelloFresh. So all those successes led to also new pools of capital because a lot of the early investors here started new funds. This includes a fund raised by Rocket, but also by Project A, for example. HV was a big investor in all of these companies and has been able to raise several funds after that. Also, the people from Point 9 were early investors in Delivery Hero, for example, and those are now the most active investors fueling the growth of the new rising stars, and that's been again fueling also the rise of new unicorns. And I think even more important than that is that it has also led to the creation of a new pool of experienced operator talent. So these are people that have run startups before, have been there before in companies scaling from 50 people to thousands of people and getting ready also to for an IPO. And here these were people doing that for the first time. Now there's a large group of talent that is able to professionalize a business and help it scale rapidly. And this is a data point that that also Peter was really keen to show. So if you look at companies that have been seed funded by a VC, they're in Europe just as likely to reach $1 billion as their US peers, which is maybe not what you would think if you hear the anecdotes. So in the US, roughly 1% of seed-funded startups reach unicorn status. And in the EU, it's basically the same percentage, and in the DACH region as well. Here on the right-hand side, you can see the graduation rate, so kind of the road to reaching unicorn status. So most startups go through several rounds. And the graduation rates in the US initially are a little bit higher, but in the end they kind of converge again, and the number of companies that reach unicorn is roughly the same. So that's really interesting. What's really special about the DACH region and Germany, but also Switzerland, is that it's a very distributed ecosystem. So you see that there are unicorns like Trivago coming from Düsseldorf, Flaschenpost from Münster, Eventim from Bremen, Tübingen, Schaffhausen, and so forth. This is very different. So Munich and Berlin have almost the same number of unicorns. So that's unlike almost any other country in Europe. In the Netherlands, it's really Amsterdam. In France, it's almost entirely dominated by Paris. And that applies to most countries. In the UK, there is a high concentration in London, although there are several other important hubs. But Germany and Switzerland are by far the most distributed, but it's really interesting. And this is a really important characteristic because if you look at that kind of flywheel that I was showing before, that means that also in Münster, there are now lots of employees that have seen companies scale rapidly. They have seen this, they have smelled the success, and they are much more likely to start something on their own. So that's a really interesting prospect for the region. Peter, do you want to take over from here?
Yes, more than happy. Thank you very much, Yoram. Yeah, let's on the next couple of slides, we will take a closer look really at the IPO and also M&A exit routes of these companies. And here we would like to start just an overview of the both value realized from venture-backed exits in the DACH region, but also the number of venture-backed exits. And as you can see on the left-hand side, there's actually a good development from 2016 onwards to 2020. So a small dip there in 2018. So there's a lot of value also realized by these exits. And in 2020, especially driven by the PE exit of Wijngaarde in Switzerland, the 4.5 billion acquisition by Inside Partners. On the right-hand side, also the number of venture-backed exits is growing. Although if you compare the two charts, or basically kind of mix them together, you clearly see that numbers are slightly falling, whereas value is increasing. And in fact, we see the same trend here for both IPO and M&A, that companies stay longer private or also stay longer independent these days. I think this is a continuous trend throughout Europe and also here visible in the DACH region, because there's such an abundance of private capital, so that a lot of these companies, they do not need to exit either to PE, corporate, or go to the capital markets to really spur their growth and develop their business. So that's why we see this difference in numbers dropping here from 2017-18 onwards. Although I think here's quite an interesting finding that, contrary to a popular belief, actually European startups are also most likely to be acquired by European buyers. So in contrast to one of the previous slides where Yoram pointed out that in the growth phases, kind of these companies really need international capital to grow their business. Once it comes at least to an exit, either to a PE or by, acquisition by a corporate, at the end, most of these companies are then still bought off by either European acquirers or then, as you can clearly see, by North American. So that means, yes, international capital is used to scale and grow these businesses, but to a large degree, once these companies exit, they are still acquired by European buyers. Interesting also that even though particularly Asia plays a very dominant role in later stage rounds, Series C, D, and above, when it comes to exit routes, Asia is not yet playing such a dominant role. On the right-hand side, you can also see some of the more valuable European acquisitions in 2020, a good mix of strategic acquirers as well as private equity firms. And we shouldn't forget that in case of a private equity exit, also the PE would like to exit probably at one point in time, either to the next PE or still capital markets is an option. Going one level even deeper. So now if we look at venture-backed DACH exits with an excess or company value of excess of 100 million in funding. We see the majority of them is either acquired by a European buyer or then a US buyer, but still 16% and then also 4% are either going public in the US or in Europe. What's also interesting that particularly in Germany, tech companies are very much likely to choose a domestic IPO. You can see here that 87% are staying within Europe, only 13% are looking for a listing abroad. The same is also true, we call it like a home market bias for France and the UK. The only country which is a bit out of the box here is Switzerland, where almost more than 2/3 of tech company exits are actually going outside of Europe. You've also indicated the top 3 sectors here. And as you can see for this kind of graph, we've excluded biotech because they play a very, let's say, special role, and also here very dedicated investors are usually active in these markets. Another interesting chart, which probably needs some time to sink in, as what did we do here? We had a look at the listing venues for these European tech companies and compared it with the market capitalization on these markets. And what you can clearly see is that despite London is leading the way when it comes to VC investments, once these companies are listed, as also shown on the previous slides, they choose European venues or non-UK venues for their listing. And that leaves us with this kind of ranking. Euronext Amsterdam, very high degree of tech listings, 251 billion in market cap combined, and that actually accounts for 27% of the tech market cap overall. Second is Deutsche Börse, Frankfurt, etc., closely behind with 239, and then also Switzerland here on the bottom with 25 billion of domestic tech listings. Maybe surprisingly that you see the European venues clearly leading and only 2 international ones with Nasdaq and NYSE playing really a major role here. Then in our following slide, let's take a closer look what kind of deep liquidity pools are also waiting for startups who tap into these capital markets, and we would like to show what kind of opportunities are also associated with this move, as we take a closer look at those companies who IPO'd maybe in the previous years and how they were able to scale their business and also grow company base and an employer base via going public. This is another very, let's say, drastic chart, just putting into perspective the different pools of liquidity available in private markets and in capital markets. Even though it's not clearly comparable, but we took a look here on what were the total funds being raised by European VCs in the last years. And I think we actually went back 10, 20 years, is close to 100 billion. And whereas when you look at the entire market capitalization of European public markets, you end up with 13 trillion. So that means the public market actually overshadows the private market by over 130. So that should actually be a very positive sign towards our founders and entrepreneurs that the liquidity pool in the capital market is even larger than, let's say, the huge amounts they are able to raise in private markets, and therefore also offer new opportunities to grow their business, to internationalize, and really scale their company to the next success level. And how is this kind of development possible? Well, on the one hand, it's definitely driven by also an increased investor risk appetite. So as we see more and more of these tech companies going public, it also helps in terms of educating the market, understanding also the market developments, price movements of these tech companies. More research is being produced. People are more confident investing in these kind of assets. So in that sense, also they've taken a longer view on profits, also on revenue, on scalability, and therefore we can say tech has almost become again like an established asset class, really having its own right in every portfolio. Another trend why this development was so successful is definitely the digital acceleration. not only by the adoption rates of users, households, but also, of course, driven by businesses and large enterprises. So what we have done here is just to compare market caps and also enterprise value revenue like 1 year ago and then currently, and you can see that particularly those tech-driven companies have made huge successes in only 12 months. But it didn't only help them to grow their business, it also helped them to grow, let's say, their headcount, so deploying new jobs into the ecosystem, basically more wages being paid. So it's lots of positive spillover effects, also indirect job creations, in particular in those centers where these startups are centered. And what's also interesting, what kind of development in terms of revenue growth they have all achieved after going public, right? So taking some examples here, like Akasol, HelloFresh, Zalando, 3 to 4 times increase in revenues, and then maybe very positive outliers, Narik, more on the SME side, and Delivery Hero, 6 to 7%, which is really quite significant. And on the job side, we even see higher numbers with, for example, Zalando and Delivery Hero increasing their workforce by 8 to 10,000 people. From the previous slides, we did take a look already at those investors being active in the private market. Now let's take a look what are the kind of investors who also invest in those companies going public. And what becomes visible is that these kind of tech companies have a very diverse international shareholder structure and are therefore able to attract capital from around the world. Now you can clearly see there's all listings on Frankfurt Stock Exchange. And yes, Germany plays a role, but definitely also US, UK are being major centers for shareholders. And then you sometimes see, I wouldn't say obscure locations, but most cases when you see Luxembourg, Guernsey, and so on, probably locations of some of the more larger asset management fund administrators. Also took a look who are the major players in that area, and you will find the likes of Naspers, Kinetic, Bale, Guilford, and BlackRock, of course, also driven by the huge amount of passive investments. Then we took one exemplary case study here for Delivery Hero, just to show you how they were able to really scale their business after the IPO with a very impressive value creation of over 23 billion since they went public in June 2017. Even before, they had very, let's say, diverse shareholder bases, lots of different funds being invested. They already made some acquisitions prior to IPO, but then also using the large proceeds of their IPO to continue this kind of acquisition spree. In 2020, for example, acquisition of South Korean Woowa. They sold the German operations to Takeaway.com. So they were really using the proceeds to scale their business and also move into different markets, internationalize their business. And I think what's also quite interesting that also with a still minus 20% EBITDA, they were finding their footing in some other markets. And interestingly, the public markets also showed a willingness to take a long-term view on Delivery Hero and supported their growth path since the IPO. In the final, the long version of the report, we also have a case study of an SME just to show the differences. But also here, it's incredible what kind of value creation we can see in the SME front. For example, we took Enphone here as an SME example, and they were also able to increase their market capitalization by 100%. Interesting, what kind of additional capital are these companies also able to raise once they are public? And it's just only 4 companies here we took as an example, and they were able to raise alone in 2020 9.7 billion. You just remember on one of the previous slides we said, I think in the entire DACH region, 7.9% of capital was raised in the private market. So these 4 companies alone were able to raise a substantially greater amount in 2020 alone by using, let's say, capital increases via the capital market, but also on the debt side, their positive rankings and ratings to issue some convertibles and so on. What you can see, they're really tapping into the deep liquidity pools capital markets have to offer, and therefore also enable further growth, both inorganic and organic. Let's come to the outlook. So when we look at not only the unicorns, but also at the companies at a valuation of 200 to 800 million, we see that the outlook is quite bright in Europe. Lots of different names from different sectors, different cities, all with a valuation of more than 1 billion, around 800 million, some of them also coming from different jurisdictions, both Germany, Austria and Switzerland, which I find quite interesting. Is we really see a very strong cohort in the, let's say, funding years 2011, 12 and 13. So again, here we can see these companies haven't exited yet, but yeah, also shows that median time to IPO, median time to exit is probably somewhere around 10 to 12 years. So there's good vintage coming up for these companies, which I think is very promising, and which will then also lead again to the kind of snowball effects Yoram has explained in the beginning. So more proceeds running back into the ecosystem, giving young entrepreneurs and founders also again capital to grow their business to the next level. And then already at the last slide here, but also a very interesting outlook, and that's basically that particular for this tech sector, the previous silos we have known that investors are either only active in the private market or only active in the public market are really interlinking and convergence more and more. And that's actually true for a variety of investors. So I'm starting maybe with the graph on the left-hand side. We clearly see a strong commitment and involvement of private equity in venture rounds. So they're moving down the ladder basically from, let's say, more pre-IPO to growth and later stage investments. So they have already accounted for 8.7 billion, for example, were active in funding rounds in 2020. But it's not only true for private equity. We also see more and more also crossover funds. So those funds typically more driven towards public markets have, let's say, really in 2019 and 20 engaged way more in venture capital, private equity than they used to before. And I think this is true really across the board. So all bigger institutional asset managers kind of companies now do have some sort of crossover funds in their portfolio, also to allow their end investors to access the private tech company space. Last but not least, not only, let's say, the institutional side, but also on the family offices side, allocation to VC and PE is really growing tremendously from 14% in 2018 to now 2018, 22%, so almost an increase by 10% in less than 10 years. And I think it's particularly remarkable because usually this kind of investor type is driven really by a more long-term view, very risk-averse investment behavior, and also they becoming more familiar with the asset class, understanding the opportunities digital kind of companies can have and are having. So the only question is, like, how can they access this kind of deal flow? And here also indirect and co-investments are the way to go for them. Yeah, with that, we're already at the end of the report, and I'll hand over to Ola again.
Yeah, great. Thanks both. I'm not sure I've seen a tag teamed presentation at an event before, so that was fun. So yeah, first of all, for the audience, do please submit your questions. We'll try and put them to the speakers. I can answer the first two that have come in, though. Yes, the presentation is available to download if you go to dealroom.co, or if you go to Twitter, DB VentureNet or Dealroom Co as well, you'll find the details. But my first question, so we just saw a lot of slides that had a lot of growth on them, whether that was those companies that went public or in the private market. Is there a bubble? I'm going to put that to both of you, but Peter, maybe you want to start.
Yes and no. I would maybe say I don't really see a bubble, because a lot of this growth is really also driven by great innovations and technology advancements, and we are not yet probably at a level we see also in other markets. So I think that's also one of the reasons why we see this kind of interest from US and Asian investors, where probably valuation levels is that's still another level, even higher. So this particularly looking also at the European market, the DACH market, to make some good bargains with very tech savvy and skilled in investments. So yes, we are definitely at a valuation high, but I don't believe it's a bubble.
Well, and you're in the private market maybe, so we see record levels of venture capital every year in lots of different markets. Is that sustainable?
I think over the long run, it is sustainable. So there's just so many things at the same time happening, and I think that it can be that that markets will kind of become irrational in phases while that is happening. But in the long run, I think what's happening is that digitization is still only at a very early stage. If you look at, for example, whether you look at fintech, it's still a very traditional business where there's still lots of innovation that needs to happen, only still kind of scratching the surface. If you go to healthcare or education or almost any vertical, and you kind of look at the details, you see there's still so much innovation that needs to happen, and then you actually realize that we're only just getting started. But of course, while we get there, sometimes we might get ahead of ourselves, and maybe there's actually not enough innovation happening to justify all the amount of capital. And you do hear a lot of worry from VCs that they think they're all piling on top of each other, throwing term sheets at founders, not doing due diligence. So that definitely doesn't sound healthy. Yeah.
And at the end there, we talked about the convergence of different investor types. Maybe some of the more institutional investors getting interested in these earlier stage companies. With that convergence moving towards kind of full stack investors, what's that going to look like in practice, beyond maybe more events a bit like this one? Open to either. Yoram, do you want to go?
You can take over. I think what we will probably see is also further standardization being pushed into the market, and also some of the, let's say, more investment criteria from the more institutional sides being passed on also to earlier stage companies, and it becomes probably visible and apparent when it comes to reporting to certain criteria. Also, I think big topic already in the let's say public world, ESG is now also being more prominent on the private market side. So I think it's one of the positive trends that the market also then kind of forced to professionalize and be even more sophisticated to cater also for these kind of very experienced investors.
Yeah, from my side, I'm really excited about, I think, what the coming years in that respect. So yeah, events like this is just the start, but you see now the emergence of some VC or at least public funds that are getting into VC. I remember just a few years ago that a venture capitalist looked like a totally different person than a hedge fund manager or a banker, and now they're kind of starting also to dress more the same. So I think that's a sign for more kind of collaboration to come.
And Peter, in your 4 years with Deutsche Börse Venture Network, what's changed in the kind of investor appetite towards these venture-backed businesses and tech businesses. I'm intrigued to know how it's looked from your perspective.
I think apart from sophistication level, even let's say rising even more, we see, of course, then driven by the developments we've just discussed, that on the later stages, companies, let's say, non-traditional public market, private market investors are now moving into that space. Means for the more traditional VCs, they are now competing with different animals when it comes to interesting deals. So actually, they are now moving also into earlier stages. So the entire focus is shifting a bit more to early stage deals, because everybody is aware that the very, let's say, top percentile companies can really choose, in some cases, what kind of investors they're letting in the cap table, and they're very selective also who's really providing smart money, who can provide you with a good network, who's probably also the best investor for these kind of challenging times we've seen in the course of last year. So these are some of the developments we're seeing, and also more and more funds are really specialized and going more into the niche. So maybe 4 or 5 years ago, they had a bit broader spectrum, and I guess now we see more and more also dedicated funds to very specialized topics, like fintech alone, biotech, deep tech, and so on.
Cool. And we had a question from the audience, which was about SPACs. I wonder if you want to talk a bit about innovation in capital markets, so direct listings versus SPACs, and what's happening in Europe, first of all, and also what that might all mean for tech companies, for venture-backed businesses. Peter, maybe you can speak to that.
Sure, I think it's a very good observation. I think we've seen record levels, in particular of SPACs, so special purpose acquisition companies, and also direct listings, particularly driven like by Spotify and Slack. We have yet to see this kind of same development in Europe. I think in some markets we saw some SPAC listings also in the course of 2020, not so much in Germany yet. I think these strategies are often used in times of high volatility. We also call them de-risking strategies, because it's a way to do the IPO and kind of decouple it with really the right market phase, market timing, and so on, because it buys you some time to find the right asset, and then basically do a reverse IPO into the cash cell. It's a bit decoupled from maybe current market fluctuations. I think that's one reason why we have really seen a surge of these instruments being used in last year, due to all the, let's say, geopolitical and so on difficulties. I think it's definitely also a trend which we'll see more and more in Europe. It's from a technical perspective, legal perspective, already available right now, so people are more willing and are open to do so. What we definitely see is that those kind of specs are coming also to Europe for looking for assets. So let's say also from a more market or more economic standpoint, I think definitely something we need to watch out for. So not only that we might lose some companies to international acquirers or listings places, and this kind of value creation is then happening outside Europe. And the same is then also true with those spec listings. When they invest or acquire a European-based target, they will also move the asset and the business away.
Cool. And we've been looking at DACH in particular during the report and while putting it together. What is particularly interesting about the DACH region with regards to tech, and what are the kind of challenges that might be particular to the region, and the opportunities where they might have an advantage? Maybe Yoram, you can speak about that.
Yeah, I think that the DACH region, and that it really started in Berlin, but as one of the slides showed, it has since really spread out to the whole region. It was like one of the earliest ecosystems to develop in Europe, and because of those early successes, there's now a whole group of VCs that is considered to be the best in Europe. Like if you look at the track record of all the VCs in Europe, and you look at kind of the top 10, then I think half of them are German VCs, and that's really important for an ecosystem. And they invest all over Europe, and some even invest globally, but they do invest a significant amount also in their home country. And so they're and then on top of it, I think the amount of talent and people that, like I said before, that have done it before is really exceptional. Where the region is still somewhat behind more, and now falling behind more and more is in employee ownership. And you see that some people are starting to there's now, I think, a significant group of people starting to lobby for change in that regard. But I think that employee ownership is like really important to accelerate this snowball effect, and that's just some room for improvement. And I think what's also interesting is having this stock market and having a stock market that's also accessible for smaller companies. I think that Germany has always had a tradition of a strong Mittelstand, and that's kind of the pride of the region. And it would be nice to see kind of that tradition also spill over to the tech scene. And actually, like we were talking about silos in the financial markets, for those same kind of silos to actually gradually erode between what's a tech company and isn't a tech company.
Yeah, and Peter, what have you seen about that, in particular, the kind of smaller scaling SMEs versus unicorns? What have you seen of that in the public markets in DACH?
I think traditionally there's still a belief that you need to be a fairly large company even prior to IPO, but we have seen also some examples in the past. For example, last year with Fashionette, you don't need to be like a $1 billion company prior to the IPO, and that's actually something we're also trying to push a little bit these days to put also into perspective that the IPO is not only an exit channel, but actually also a way to fund your future growth, so that you can also do further capital raises once you're IPO'd, up to a certain threshold, even without prospectus. So I think these are some of the mysteries about the capital markets, which are still out there, and we need to do our homework to get rid of some of these myths and really provide a good picture with like a proper planning and some dedication. Yeah, even for smaller companies, it sometimes makes sense. If the equity story is right, to use the capital market also for scaling up your business.
Okay, so a very specific question then from the audience on that actually is, what is the current minimum float for an IPO in Frankfurt to get good liquidity in the aftermarket?
I think you need to be careful what's the minimum and what's a good criteria. So I think if you be around 20 to 30 million is probably good. What most people say, if you really would also like to attract more the small mid-cap kind of funds, which are really important also to have in there for some stabilization measures and so on. Yeah, 80 to 100 million free float is probably a good way to get started.
Cool. And have you seen the age of companies going public change at all? Are they is there a certain age that a company is when it tends to go public? Is that getting later as there's been more of an abundance of capital in the private market? What's been happening with that?
Definitely, it's a trend I think just started 5, 6, 7 years ago, and I think recent numbers are saying that whereas in 2005, 6, 7 usually took a company 6 to 8 years going public, and nowadays we have reached median values of up to 12 to 13 years. And that's also was the point I was mentioning on the very last, one of the last slides. When we look at the funding years of some of the unicorns we're seeing nowadays, or potential unicorns, we have a lot in this bracket, 2011-12, where you can argue, okay, maybe 10 years ago, these companies probably would have been public already or would have been acquired by a PE. And then nowadays we see that they're all still independent. And that's definitely a trend we are seeing due to the, let's say, good supply of capital in the private market.
Okay, and so related to that, during the presentation, Yoram, you showed the percentage of capital that unicorns raised at different stages and from what locations. And there was a big trend towards it going much more international at later stages. So they could raise seed quite easily at home, but have to look abroad when you get into the tens and hundreds of millions. What do you think might change if we were to look in another few years, look at the next cohort of DACH unicorns and what their funding journey looks like? Do you expect that to change at all, or is there still a gap?
There's definitely still a gap, but it's probably will improve a little bit. And the reason that I call it an improvement, if there's a bit more domestic, it's not because it's bad to raise from US or Asian VCs. And I'm sure that if you talk to those companies, that they actually really want that global capital also in their cap table. But it's about having a right balance, and it's about like who's on the board. And if your whole board is dominated basically by people from the US and or Asia, then and you have that happening in all your biggest tech companies, then that's not good for the ecosystem. So it will improve, but there's still I think there's still today a lack of late stage venture capital.
Okay, and I think we can take a look at, there's another few questions that have come in. So I've just lost the one I was looking for. So yeah, do you think there is too much equity in the market? The companies in the presentation are only a handful of overall the ecosystem. We see a lot about the other 98% either being bought out very early by a large peer or failing. So yeah, I don't know, Peter, do you want to speak to that?
Not sure whether I got the question right. So I think, if I understand correctly, so yes, definitely we have focused maybe on some of the slides more on the top tier companies, but I think that most of the findings are also true for the majority of clients. So is there too much equity? I don't think so. I think it's even distributed across the different regions and also sectors. And yeah, I would say most of the findings which we have indicated throughout the report are true not only for, let's say, the top 10 kind of companies in their respective sector, but maybe then to a lesser degree or with less significant still the major trends also for smaller companies.
But another way also to look at that is if you look at the US for a moment, which is a more mature venture capital ecosystem, and there is way more equity being invested there, and the impact that has on the economy, I think we showed it in a different presentation before. In the US now, 10% of the population works at a venture-backed company. More than 50% of all the R&D that happens in the US is done by venture-backed companies, and arguably that 50% of R&D is probably has like 90% of the return also on investment of that R&D. And here in Europe, where if you look at amount of equity invested per capita, it's like probably 1/4 or perhaps even less. And outside of the UK, it is even less. So there's still way more to be invested. And of course, you can't do that, you know, overnight. It has to be a gradual process. But there's actually not enough equity in the long run if you think about it. And the Mittelstand from before is not going to be the same, look the same in 10 years time. It's going to drastically change. And if you don't want to be kind of overrun by US companies that completely dominate all the technology, you're going to have to really start investing a large amount of money.
And yeah,
to the question again, I think to add to Yoram's point, yes, there are a lot of companies being bought off the chain, let's say, prior reaching maturity and also scalability, and that's probably also one of the reasons why we have discovered that in terms of conversion and probability, that a seed-funded EU or European tech company is almost as likely to unicorn status as a US company. But then if you look at the amount of unicorns and we see, okay, there's still like a 10 times, 15 times difference, we need to ask ourselves, okay, where's this difference coming from? If, let's say, chances are almost the same. And I think one reason is definitely that along the way, first of all, we do not have enough companies we put into the funnel, but then also along the funnel, a lot of these, let's say, very promising startups are then also bought off by their peers, by, let's say, the big tech companies who are already established, and definitely also by some of the more larger corporates as strategic investors, so they don't reach the exit channel and then being available either for an IPO or further PE exit. Definitely the case.
And we've sort of been celebrating in Europe the fact that tech companies have been able to stay private longer and reach scale before exiting. You know, in a company like DeepMind might not be acquired by Google anymore if it was scaling now, for example. But a question from the audience is, what impact does that have on employees and early investors if a company stays private longer and they're unable to access that liquidity, or is there another option for them? Yoram, can you speak to that?
So if a company stays private longer, if that's good or bad for the employees?
Yeah.
I mean, I think it depends what you call early. So in the US, companies stay private for a really long time, and you can see that sometimes they stay private actually for too long, and so kind of a black market almost start to be created for those stock options. But yeah, it definitely sounds like a healthy system where a company can actually go public already earlier, and maybe there is this perception that you should wait as long as possible, but it would be good for employees if they get if there's a possibility for early liquidity, and but of course that only matters if you have employee ownership to begin with.
I agree. I mean, the question was also posed in a way to say we have celebrated the private tech boom here. I think it's a good question also, who can celebrate us? I think certainly parties who can celebrate, and that's fair enough. But also if you look at the broader public, I mean, not everybody is able to participate in this value creation. And I think therefore, exactly what Yoram pointed out, these companies going public at an earlier point in time also allowing retail investors or more pension kind of type of fund structures investing into these assets would certainly help if also they can participate in this tech boom we are seeing to some degree. And on the other hand, I think that's also one of the reasons why we're seeing also a large increase of these private market platforms, where exactly early stage employees, founders, business angels can at least sell off some of the liquidity as the company's exit is even further away.
Great. Well, I think we're just about out of time. So thank you so much, everyone, for joining us. I think it's been a really interesting discussion, and again, you can download the full report by going to dilroom.co. Just to round up a few of the interesting thoughts there. So in conclusion, the Mittelstand isn't going to look the same in 10 years' time. The whole economy needs to be able to participate in this tech boom, hopefully, and investors are starting to dress the same. But yeah, some really interesting points, and thanks for joining us, everyone, and see you soon.
Thanks, Orla.
Thanks much. Have a nice evening, everyone.
Bye.